Gold price drops $25 from $2,000 as U.S. set to avoid debt default, Fed a bias to raise rates to two-decade high. The gold price slipped to new two-week lows in London trade Wednesday, extending yesterday's steep drop through $2,000 per troy ounce after strong U.S. economic data and comments from Fed policymakers saw the market consensus on interest rate cuts start to retreat. Democrat President Joe Biden meantime cut short a visit to Asia for talks at the White House with Republican House Speaker Kevin McCarthy over raising the U.S. federal borrowing limit from the current $34 trillion ceiling to avoid a debt default and government shutdown, likely to start the 1st of June. Trading at $1,985 around 10.30 UK time today, gold bullion set its first London benchmark below $2,000 since the 2nd of May, snapping a record run of 9 sessions above that level and heading for its cheapest afternoon fixing price since mid-April at $1,975 around 3 p.m. For U.S. interest rates, if there's going to be a bias to action, for me it would be a bias to increase a little further as opposed to cut, said non-voting Fed member Raphael Bostic, head of the Atlanta division, on Monday. Inflation is still high, we have to stick to what we're doing, said fellow alternate member and Cleveland Fed President Loretta Mester on Tuesday, and smaller, less frequent steps will help higher interest rates avoid causing financial instability, added voting member Lori Logan, president of the Dallas Fed. U.S. retail sales, industrial output, and housing market activity data meantime all came in stronger than analysts had forecast yesterday, helping the dollar to rise and knocking the gold price $20 lower inside 3 hours to $1,990 as betting jumped that the Fed will in fact continue to raise its key interest rate next month. In contrast to gold, global stock markets stabilized Wednesday, holding a little above Tuesday's 8-session low as market-priced odds suggested by the CME derivatives exchange's Fed Watch tool now see a better than 1 in 4 chance that overnight rates will rise to a ceiling of 5.50% in June, the highest since New Year 2001. I think at the end of the day, we do not have a debt default, McCarthy told CNBC today. The timeline is very tight. But we're going to make sure we're in the room and get this done. But investor indifference to the threat of a prolonged debt ceiling impasse has left a handful of tail risk strategies almost too cheap to pass up, says Bloomberg, quoting Bank of America analysts now advising clients of a long gold, short equities strategy on options contracts they claim would return 30 to 1 if the talks in Washington fail to halt panic as they did when the U.S. was downgraded from AAA by global credit ratings agencies, sending gold to a then record $1,920 back in summer 2011. Gold is ripe to be the beneficiary asset class amid a range of today's political and financial stresses, says Swiss bank UBS Christine Gilfillan, head of Precious Metal Sales Americas. It can wear many hats, whether it's for diversification, inflation, geopolitical tension, or the lifeboat to the rumblings in equity markets. Tuesday also brought data showing that China's industrial output, fixed asset investment, and retail sales growth all accelerated much less than analysts expected in April, while the UK's unemployment rate ticked up to 4.0%, but wage rises held firm, and economic sentiment across the 19-nation Eurozone sank to a negative reading for the first time since December. While Wednesday's U.S. data said new house building starts rebounded a little in April from March's slump, the number of new building permits issued continued to fall.